Folks, it is official. The banking collapse of 2023 is now bigger than the banking collapse of 2008. The now 3 banks that collapsed in 2023 had more assets than all 25 banks that collapsed in 2008 did, according to Zero Hedge. And in fact, you now have PacWest hemorrhaging value in the after hours today, as it just came out that they too are looking for a buyer. And who knows how many more banks are coming next. We keep hearing every time a new bank collapses that this is the last one. And then a week later, the next one collapses. And they say the same thing, and it's the same game over and over again. So the question is, how can we keep seeing this contagion spread when regulators and authorities promised that everything was under control? Well, it's because they lied. That's why things were never under control, and things are continuously getting more and more out of control. And folks, stocks of similarly sized banks and profiles as the ones that have already collapsed are seeing shareholders continue to rush for the exits in real time. And as these bank share prices go down, their ability to raise capital and save themselves if they get hit with the contagion of deposit withdrawals gets completely compromised. Now, if things were as bulletproof and solid in the banking sector as we are supposed to believe, and as our favorite bingo grandma tells us, well, then you got to ask yourself, why are shareholders in exodus mode on these stocks instead of buying the dip? Why are shareholders willing to sell their shares that they probably purchased at 10 to 20 to 30, even 100x higher prices, now willing to sell them at 90% off or more? If it's such a surefire thing that no more banks are going to collapse and that their banks are going to do fine. Well, they are selling them because they don't believe it. They are extremely confident that the pennies left in their position are worth more than what they're going to have in those positions a year from now or in a month from now. Why? Well, because the banking system is in great danger and it's likely going to get way, way worse. And I know we've said this a lot over the last 2 to 3 months. We even made banking videos back in the fall before any bank had collapsed. And every single time it's like, well, Charlie is trying to sell fear. There is nothing wrong with the banks. Ask Janet Yellen. She says everything's fine. Even today at the FOMC meeting, Powell said everything is fine. Then look what's happening in the after hours with PacWest. Look what happened earlier this week. You're at this very, very interesting point in the cycle where you're not allowed to talk too much about the banking collapses and say that these could be a contagion. And the reason that you're not is because it would reveal that a lot of the other banks that are still standing today have a lot of the same exact profiles and problems that the ones that have collapsed had. And if everybody talked about it, well, more and more banks would collapse. And so there's this concentrated effort right now to control the narrative on this banking collapse, but people are waking up to the fact that, hey, while these people are telling us the banks are safe, well, they're going and they're withdrawing their own cash. They're telling their families to withdraw their cash. And it's only the suckers that think everything is fine and dandy and are going to end up holding the bag, so to speak. In today's video, I want to discuss with you the spiraling banking crisis, how more and more wealth and power is concentrating in Chase, which banks are likely to be next on the chopping block, and some details that you should look for if you're wondering if your bank is going to collapse. But before we get into it, I do want to give a quick plug. If you are looking for a reliable platform and a broker for your trades, make sure to give our partner Moomoo a look with that first link down below. Excellent platform and broker. And if you are someone trying to trade off all this insane volatility and all the opportunity with that, well, they are a must-have. And by the way, Moomoo is a member of the SIPC, which protects securities customers of its members up to $500,000, including $250,000 for claims for cash. Very important in the greater context of what's going on right now, right, folks? And they're also offering to give you up to 15 free stocks if you sign up and deposit a small amount with our link down below. Make sure to give them a look. Okay, let's get to work. So I want to start with how Chase is using this banking collapse to solidify itself as a too big to fail and too big to mess with bank, and how it is effectively getting regulators to concentrate more and more power into its own hands. From the Wall Street Journal earlier this week, regulators seized First Republic Bank and struck a deal to sell the bulk of its operations to JP Morgan Chase, heading off a chaotic collapse that threatened to reignite the recent banking crisis. JP Morgan said it will assume all of First Republic's $92 billion in deposits, insured and uninsured. It is also buying most of the bank's assets, including about $173 billion in loans and $30 billion in securities. But see, here's the interesting part here, because CEO Jamie Dimon claimed in a press release that this acquisition only modestly benefits their company overall. So why would he initiate something that is only modestly beneficial? Why would he go out on a limb to do a risky takeover if there wasn't more than modest upside. Jamie Dimon and Chase oversaw the takeover of major banks back in 2008, and he said later on that he really regretted that because there were so many risks associated with that and many regulatory uncertainties with that cost Chase billions of dollars. And he said that it wouldn't have been something that he'd do again. Yet he's going out now and doing this again. And he's claiming that this would only be modestly beneficial to his bank. So then you got to ask yourself a question. Why would the CEO of probably the most well-run bank in history be willing to take on a massive risk if there wasn't more than modest upside? Is there not a bigger play here? Well, yes, there is a bigger play here, and here's several of the big reasons why I think they did it, and why it actually isn't a modest benefit, but a pretty damn big one. The first part is that Chase bought this while it was in the FDIC receivership position, and it negotiated a deal where it had the opportunity to essentially buy out all of the good parts of the bank while allowing the FDIC to cover a lot of the bad parts and a lot of the losses. And in fact, one of the areas that Dimon and his team were worried about was the residential and commercial real estate segment of First Republic. Well, he got the FDIC to cover 80% of the loss on any of those loans. 80%. And quote, all told, the FDIC estimates that the receivership of First Republic will cost its deposit insurance fund, which is financed mainly by assessments on U.S. banks, about $13 billion. Not only that, but JP Morgan will not be assuming any of First Republic's corporate debt. So the first reason this made sense for Chase is because they get an easy and fairly large boost. I know Chase is a massive bank and it might seem like a drop in the bucket, but they get a pretty easy boost to their deposits and growth in many different segments that Chase doesn't have massive exposure into. And they get all these benefits, but they get to share the accompanying costs of those with the FDIC. And at some point, upwards of 80% of the losses and the costs. Now, the other benefit, and I think this might be even more important for Chase, is they get to surpass the often impossible task of getting regulatory approval and seeing a lot of regulators try to destroy Chase's ability to continue to take market share in this overall banking sector. Regulators usually tend to be pretty hostile towards corporations that try to completely dominate any sector. It's not often that CEOs enter high-profile bidding contests for things they expect to just modestly benefit their companies, but it's also not often that a 3.7 trillion asset bank gets instantaneous regulatory approval to gobble up substantially all the assets of a $229 billion asset bank, plus about $100 billion in deposits overnight. So here's the thing, folks. Not only did Chase get a good deal by taking on all these new clients' deposits without much of the accompanying losses, but at the same time, they've just solidified themselves even more as a bank that is too big to fail, and one that regulators are going to be too scared to mess with because it's going to come back on them. And the more banks Chase gobbles up and the more regulators become dependent on them, the more capital Chase can attract because people know that Chase is going to be the last man standing. Right now, it is the last man standing, the only one in the private sector standing before you get to the Fed and before you get to Congress. This buyout for Chase is a way of signaling and flexing their strength and sending a message to regulators and potential depositors that, hey, we are too big to fail. More and more of the country's wealth and power is being concentrated in fewer and fewer banks, and Chase is the main beneficiary of this. So for me, I think JP Morgan's Jamie Dimon saying this is going to be modestly beneficial is just a way to control the narrative so that he doesn't have the media going up in arms about him essentially building a monopoly in American society in the banking sector. Jamie Dimon, in my opinion, has been one of the best and most effective CEOs and leaders in corporate America, probably in history. I definitely have nothing against him and nothing but respect for him, but the government is creating this dynamic where banks are getting bigger and bigger, partially because there's no other option, because they don't want the FDIC to take as big of a loss and have to deal with complete bailouts like they did with Silicon Valley Bank. But in doing this, they may create a much bigger monster down the road. But anyways, folks, where should you start looking if you're wondering what the next banks are that are going to head for that big C word, the big collapsivo? Well, if you want to figure that out, you got to look at the characteristics that made the other banks collapse, the risk factors. Well, First Republic Bank was a bank that relied heavily on wealthy clients, had 2/3 of its deposits surpassing the FDIC's $250K insurance limit, which meant that at any point where there's any sign of trouble, those people are going and pulling that money at a rapid rate. And the bank had hefty unrealized losses on long-term treasury bonds, which meant no liquidity to pay them out with. Silicon Valley Bank, similar ordeal to a worse extent, mostly wealthy clients, mostly locked up reserves in long-term treasury bonds, which have turned toxic, or in bad loans. And quite frankly, unfortunately, those characteristics sadly match a lot of regional banks to varying extents. The Hill reports U.S. banks had $620 billion in unrealized losses on securities at the end of 2021. 2022, according to the FDIC. A March study from professors at New York University and Wharton estimated that their unrealized losses are closer to $1.7 trillion when accounting for all loans and securities. And if you want to see which banks the market thinks are most likely to collapse next, a good way to do that is to look at which ones are being beat down the most. Right now, one of the biggest losers is PacWest Bancorp, which is, by the way, down another like 50% in the after hours today. It just came out again that PacWest is expected to start weighing strategic options for a sale, which is the dirty press release that starts almost all the collapses that we've already seen. This is yet another California bank going under. I don't know what's up with my state and these banks. They just can't seem to operate here. And it seems like this is going to be another one that just falls into receivership before any bank can buy them out. Bloomberg reports an outright sale has been hindered because there aren't many potential buyers interested in the entire bank, which comprises a community lender called Pacific Western Bank and some commercial and consumer lending businesses, the people said. A potential buyer would also have to potentially book a big loss, marking down some of its loans, the people said. And you look at who PacWest's clients are, it's not surprising that a bit more than half of their clients are uninsured depositors. This is a bad group to have high exposure to right now because these wealthy depositors are much, much more likely to leave at any signs of trouble and actually create a self-fulfilling prophecy, right? They don't want to risk their hard-earned and uninsured deposits being blown up, so they rush out and, in effect, cause other people's deposits to blow up. And what's very freaky about this is this bank's exposure is only at about 52%, which is a big jump downward from the 97% and 90% that we were seeing before with SVB and Signature and the 68% that we saw with First Republic. So if this contagion continues that trend of batting lower and lower and starts knocking out numbers that are in the 60s, 50s, even 40s, well, all of a sudden you're going to be in a situation where if you're in a small and medium-sized bank, whatever it is, you're going to be like, okay, I need to just get the hell out. I don't want to risk something bad happening. I'm just going to go ahead and pull my money out and put it into Chase or B of A or whatever the heck it is. And in doing that, that's going to cause the contagion to spread much, much further. And you're going to see more and more consolidation of banks into bigger and bigger banks or into the FDIC and overall regulators' hands. So practically then, what are some ways to tell if a bank is going to go under next? Well, if it's a small to mid-sized regional bank and it has a very high percentage of wealthy clients with uninsured deposits, those are likely going to be the ones to pull the plug first at any signs of trouble. So those are the ones that you should watch out for. If you look at the top 10 banks with the biggest percentage of uninsured deposits, you had your Silicon Valley Bank, which of course already collapsed, but then you got your New York Mellon, your State Street Bank, your Signature Bank, which again already collapsed, Northern Trust, Citibank, although to be fair, Citibank is much, much bigger than the others on this list and they have a lot more capital to work with, so wouldn't put them on a high-risk basis. And if they are on a high-risk basis, that means we're in a pretty damn apocalyptic situation. You have your CIBC Bank, you have your HSBC Bank, your City National Bank, and of course you have your First Republic Bank, which already collapsed. I think you're probably going to see a few more of these see massive exoduses of capital if PacWest collapses. If PacWest collapses, everyone's going to be waiting for that next straw to break, and it's probably going to be another one with huge exposure to uninsured deposits. So anyways, folks, I suppose that is your update for today, but my final closing message is, folks, please do not panic, because if you panic, it will reveal that our banking system is a fugazi with very, very little back in it, and we can't let that be revealed, because if it gets revealed, pretty soon Jamie Dimon will have more power than Jerome Powell. Chase will buy up the entire economy, and we'll all just be working as employees for JP Morgan Chase and its subsidiaries. And Jamie Dimon will say, don't worry, this only has a modest benefit for our shareholders. Anyways, folks, that caps off today's videos. Have a great rest of your day, and we'll see you in the next video. Make sure to take advantage of that Moomoo link down below. Make sure to take advantage of the coupon code WAR to get 60% off our ZipTrader U program and its one-time fee for the step-by-step lessons and private chat and daily morning briefings. Have a great rest of your day, and we'll see you in the next video.